the market, which was down 300 before he started talking, ended up actually up on Friday. However, the Chinese government officials did tell major state-run agricultural companies today to pause purchases of some American farm goods, including soybeans, as Beijing evaluates the ongoing escalation in tensions. So specifically, the state-owned companies of COFCO and Sinograin were ordered to suspend purchases. Also, they have canceled an unspecified number of U.S. pork orders. Now, private companies, though, have not been told to halt imports, at least yet. So people are watching that development. In Europe, we had some relatively pleasing manufacturing PMIs. They were all below 50. That was expected, but they were all up from April. So, of course, it is the trajectory of what's going on that the market is worrying about, and it seems to be going at least in the right directions. Domestically, health officials are warning that the mass gatherings that have happened over the weekend in the protests will probably exacerbate the outbreak. Here's what Scott Gottlieb said. He was the former FDA director. I think there's going to be a lot of challenges coming out of the events of the past week. One of them is going to be that probably chains of transmissions have gotten lit by large gatherings. I don't really think there's a question about that. So a couple of things. We're going to take a look at what civil unrest has done to the markets in past times. So stay tuned for that here. Domestic reports, ISM manufacturing index for May ticked up to 43.1. That's up from 41.5 in April. But remember, it's below 50, so it's still not expanding, but again, at least it's better than April, which is what the market seems to be caring about. We also had construction spending decline 2.9%. Key takeaway, though, is construction spending is still up 3% year over year in spite of all that's what's going on. So we've been watching the home building stocks, as you know, and they have been doing very well. All right. Anything else you want to cover in the news, Mark, that I might have missed?
Yeah, there was this one little event at Cape Canaveral on Saturday.
Yeah, that's right.
Kennedy Space Center. SpaceX launched successfully. The astronauts made it to the space station. First launch from U.S. soil in 11 years, if I remember right.
Yep, that's good. And some good news for a change. All right, let's take a look at the dollar. The dollar is weakening today. It was right on Friday. It was at the dollar index itself was at 98. Just a shade less. So people have been watching the 98 level. So this is even lower today. This drop in the dollar then is helping some of the commodities. Let's take a look at gold. So up a little bit, but really range bound rather. But basically, I'd still say many traders would rather be long than short gold. I think the fundamentals are still okay. What I mean by that is low real interest rates. Now, so that is positive for here. Let's take a look at the.
Hey, Lee, before you move on, one point I'd like to add on that. We had a very wide range there back in March, but we've now moved to a higher range. And this is a good example for any type of a chart. In order for this to really get bearish, the very first thing it's got to do is to get below and then stay below that level.
Right. It's about 1680-ish.
Yeah. Unless it does that, bulls are still in control.
That's right. All right. Let's take a look at the silver. We told you to watch this one. The gold silver ratio is normalizing. We just broke out of this flag on Friday, and it's continuing today. Seems to me probably go test the high here. Now let's take a look at the mining stocks for both of those. Let's take a look at the gold miners first. Moving out of a pullback, to your point, Mark, still making higher lows there.
Yep. The trend is your friend until the end when it bends.
That's right.
And it hasn't ended and bended yet.
Yep. I got a little resistance there at the 10-day moving average, but it's relatively minor. We did pause there just a second, though. You can see the tail right there. It was at the 10-day. Let's take a look at the silver miners. Yep.
Oh, it looks very similar.
Yep. A little bit of a more energetic move because silver is up more than gold. Let's take a look at the gold-silver ratio again. It's been, as we pointed out, that it was out of whack, then silver would probably start catching up at some point. And yeah, we're still elevated, so maybe silver still has some relative performance versus gold. But you can see, over the last couple of years, it's been around 85-ish, and we're still at 94. So there's still a little room for relative performance in silver. Let's take a look at copper.
Dr. Copper.
It is not necessarily a leading indicator anymore. It's turned more of a coincident indicator, but it is certainly going the right way to confirm the strength in the equity markets. So again, the trend is your friend until it stops. Where might it stop? Well, not necessarily turn around, but we are coming up to a pretty good resistance level at 250. It'd be interesting to see if it can break through there, but that's certainly about where we can go before we might pause a little bit. All right. Also, looking at the commitment of traders report over the weekend, there wasn't any new extremes, but we've been telling you that the hedgers and index futures are not doing what they usually do. We pointed this out 3 weeks ago that it was bullish, in that as the market started going up, usually hedgers go the other way, and they have been maintaining their long position in index futures. And actually, they've even bought a little more. They've got about $48 billion now long. So it's extremely unusual to buy more, or even to hold, or even buy more. Stocks are rising. When we've had such a position over the last 10 years, it's not that often, but when we have, the equity markets continue to go higher. The other one where the hedgers have a pretty big long position is in corn. Other than that, nothing hit my 3-year maximum screen. All right, let us take a look at our bond signal, see what the rates are doing today. Take a look at the 10-year first.
Whole lot of nothing.
Whole lot of nothing. Yep. Let's take a look at the 2-year yield. We look at this because Jeff Kleintop, our chief global investment strategist, is looking at it. And it hasn't moved. He would like to see that turn up. So we still have this little bit of a dichotomy with what the bond market is saying and what the stock market is saying. We would like the yields to start going a little bit higher, I would think. But I don't know, you have any thoughts on interest rates, Mark?
It's amazing to me to see how volatile they were in March. I mean, you look at the move in the 10-year Treasury. I think it was something like 11 days once it broke below 1.5%.
Yeah.
To get to 40 basis points. 7 days later, it's at 1.3.
Yeah.
3 days after that, it's back to the top of the range. I don't know what that would translate into in Dow industrial terms, but the 10-year yield, I've said many times, it's the quote Dow industrials unquote of the bond market. In that if you ask someone, well, hey, what did the stock market do today? Oh, the Dow was But if you ask someone what the bond market did, it's what the 10-year Treasury yield do. So we've had that just incredible volatility, and then now we're back down to virtually nothing. Now, one thing that fundamental analysts and technical analysts agree on is that volatility is cyclical, and as such, it's somewhat predictable in that low volatility begets high volatility. High volatility will calm down. So you're seeing living proof of that in the bond market. Lee, do you have Bollinger Bands you could put on that?
Sure, let me do that for you.
Because Bollinger Bands are an indicator that measures volatility because it takes the 20 period moving average, or in this case, a 20-day moving average, plus or minus 2 standard deviations, which are measures of volatility. And if you can change the colors on that, that's really hard to see. Bright like yellow. Yeah, there you go. So as volatility increases, you'll see the bands expand. And in fact, you notice when price breaks down below 1.5, that the upper band actually moves higher. And what that's signifying is that the volatility is increasing so rapidly that the upper band needs to move higher to keep up with it. And if you look at the band width, and there's actually an indicator to look at that, it will show you how wide the bands are. So one thing Lee talks about in the indicator lab is when that upper Bollinger Band, in this case, starts to hook lower, that doesn't mean it's the end of the move, but it's the end of that first thrust, if you will. And now, of course, the bands have become calmer. So if you look back to the beginning of January, when the bands were relatively very tight, that's an example of low volatility that begets the high volatility we saw in March that has now calmed down into low volatility again. So it's just another way, and the same thing happens to individual stocks, it happens to indexes, happens to commodities, just as a measure of what happens in the market when volatility expands and contracts.
Very good, very good. Let's take a look at our bond signal. It's getting maybe ready to cross. We'll have to see, but it's been a pretty good signal over the years. It's 2 moving averages, the 20 and 50 period exponential moving averages. We look at the cross. Again, we don't give advice, but you can see the signals in the past have been okay with this particular trend following system. So we're watching this for the cross to see if it finally happens or not. All right, let us take a look at the stock market.
What, you mean there's another market out there besides bonds?
There is indeed. All righty, so I'm just going to take off everything on this chart, and I'm going to have Mark give us his analysis. I'll put on whatever you want me to help you comment.
Okay, so the first thing would be we certainly have a very steady trend in place here that's moving its way higher. If you would, put a horizontal line across the chart at the that first peak on the lower high on the way down in March. You go back up the first lower high in March, go up a little bit more. There you go, you got it. So that's where the next place we might have some overhead resistance. I typically will look at my charts first and foremost with basically no indicators, or what I call naked price. But if you wanted to check something else out, let's take a look at RSI. Okay, and then if you can expand that one a little bit, perhaps, there you go. And what's our current reading on RSI? I can't see that.
64.55.
Okay. Now, RSI, of course, was developed by Wells Wilder. But the thing I'm going to talk about, and I think you talk about some in your RSI indicator lab, was actually developed by a gentleman named Andrew Cardwell. And he identified that during bull and bear markets, the ranges for overbought and oversold on RSI aren't always 70 and 30. During bear markets, RSI will tend to get oversold at around 20. And if you look at the March lows, actually the big drop in terms of the lowest oversold in terms of RSI was actually that first short drop. And during bear markets also, it tends to peak or be overbought, not at 70, but at around 60. And one of the things that will happen typically when a market changes from a bear to a bull regime is that RSI breaks above 60. So you're holding there at 52. Can you hold at 60? Show where that is. There you go. So it literally just recently broke above that. Now in bull markets, overbought may be as high as 80, and oversold typically happens around 40. So you can actually just think in terms of RSI as a secondary confirming way to look at a trend. But first and foremost, price, and unless and until price breaks beneath that most recent low or at a bare minimum. Lee, could you move that down to the May highs from like midnight? Yeah, there you go. So the first thing that would have to happen to even think about being bearish would this breakout would have to fail and the S&P 500 drop back down below 2960. That's just the first step. In order for the trend to really change, it would have to drop beneath those mid-May lows at around
2750.
2750-ish, yeah. So if you're currently holding long positions, one way to think about it might be to trim some if the breakout were to turn into a fake out, a breakout failure, where we drop below 2900 and stay there. And then you might want to trim a little more if we drop below the 2750 level. Just think in terms of what will I do if? If this happens, I'll do this. If that happens, I'll do that. So is that kind of what you had in mind, Lee?
Absolutely. And I'll just put up one other confirming thing here. We've also been holding the 200-day moving average now for the last 4 days, which is
The
positive.
flat as a pancake 200-day moving
Yeah.
average.
Yeah. So
Oh, actually, here's another idea. Put up the 50 as well. See how close we are to getting that golden cross.
got a ways to go still, but
Okay. So down in the bottom, this is something I have you do periodically. You know where I'm going to go with that, right, Lee?
yep.
Set the number of days to 50, and let's see what's dropping. So you can see 50 days ago, those values that are dropping are significantly below where we are today. So that 50-day moving average, unless we have a serious drop in the markets, that 50-day moving average is going to continue to move higher, moving towards that so-called golden cross. And again, like I emphasize every time we talk about this, ladies and gentlemen, this is not prediction. This is simply math. We look at what's falling off, and those are lower values to be replaced with higher values. By definition, the average continues to rise.
All right, we got some questions here. Copper, is it a bear wedge? It would be if it breaks the lower trend line.
Mm-hmm.
Yep, but it hasn't yet. And if it breaks the upper trend line, then I would say also look at the 50-day moving average on that too. It's giving good support too. But to your point, yeah, when you have a kind of a triangle pointing that way after a downturn and a rally, that is considered a bear wedge, but it's only actionable if you break that. If you break, that's right. Okay, what I wanted to do briefly is we're having all this civil unrest I've gotten lots of questions. What does that mean for the market? So let's just look at two analogs. All right, as I said, I have what the Dow's done every day since basically 1900. This is 1967. Okay, and those two arrows there, I don't know if you remember, but if you're as old as we are, we remember the summer of 67 was called the Long Hot Summer. There were 159 race riots in 2 months, okay? If you remember. It started in Buffalo in June 26th. There was one in Cambridge, Massachusetts, Cincinnati, Detroit, Milwaukee, Newark, Plainfield, Saginaw, and Portland. The time that the riots went on was a month period from the end of June to the end of July. So I have that in here for you, and you can see the market just doesn't care, unfortunately.
And we got to put that in context with the times, because it wasn't just that one summer. I did some looking since you and I talked, Lee, and many people might remember the Watts riots in Los Angeles. That was actually 1965. As a kind of a funny side note, one of my college roommates at West Point ultimately left the academy and joined the LA Fire Department, went on to become the captain of the Watts station many years later. But that whole era, the mid 60s, was really a lot of racial unrest.
That's right. I would also point out, I didn't bother to build a chart of this, but 1968 also is an analog. Because remember, we have both a pandemic and racial unrest right now. Ditto for 1968. Remember, we had the H3N2 Hong Kong flu in 68, which killed 100,000 Americans. Kind of sounds familiar, unfortunately, with what's going on now. And we also had, of course, very contentious election season in 68. We also had the assassinations of Martin Luther King, Robert Kennedy. North Vietnam launched the Tet Offensive. So what did the market do? After a 9% drop from January to March, the market rallied 24% and ended the year with a gain of 8%. Yeah, you want to see the LA riots too? I've got that built too as 92, not 93. Let me pull up that chart.
Before you move on from that one, Lee, one other thing to put in context from that era is the market, the Dow Industrials peaked at 1,000 in 1966 and didn't break above 1,000 until 1982. They spent those 16 years mired in a range between 700 at the low and 1,000 at the high, with a brief dip below 600 to 550 after President Nixon resigned after Watergate in 1974. So it's a different market regime than we had back then as well.
Right. So here is 1992. I lived in LA during that time, and April 29th to May 5th was the LA riots. The market went up. All right. So unfortunately, the market doesn't have any empathy one way or another. It is what it is.
And perhaps another way to look at that, Lee, would be is that just like the market has with COVID, the market tends to look forward, and in this case, I don't mean as in pleasant anticipation, looks through what's happening now to the ultimate recovery. And even in those days, riots had a relatively short life. And it's not to minimize anything that was going on back then or now, but they tend to burn themselves out. No, and absolutely no pun intended there. But it tends to be something that doesn't last a long time. And ultimately, the recovery is what the market looks towards.
Okay, let's see here. Let's go to the NASDAQ 100.
We also had a question about the Russell 2000.
Well, actually, let me put up then, because that was actually directed to you. I was going to do that when we did the Russell. Let's do it now. So there is the Russell. Let's compare the Russell to the S&P P, and then you can answer that question. Just restate the question, and we'll take a look at it.
Sure. Chuck in Oklahoma. Um, you've got definitely some outperformance in the Russell here recently, which helps in many ways with the market. First of all, it increases the breadth because there are far more small cap stocks than there are large cap. But we have to remember that the Russell has been underperforming for quite some time. So if you could go first to a weekly chart where you can do a relative strength versus the S&P 500. Go back, say, 3 years or so.
3 years, all right.
Yeah.
And then I will put up the relative strength study.
Yeah. And just from looking at that price chart, you saw that whereas the market has the S&P 500, the Dow have moved higher, the peak in the Russell was actually looks like August of 2018. By now, nearly 2 years ago. And Lee, can you change the color on the price relative? You must be in a dark and somber mood today, my friend. Lots of dark and somber colors. There we go. Perfect. So you can see that the Russell has underperformed the big cap index for quite some time. And now it's starting to, just in the short run here, that underperformance is easing. I don't know if I'm phrasing that right. It's got a lot of room to play some catch-up ball.
Yeah. So, but I think it's decent for the market that maybe we're getting a little bit of
Yeah.
rise in that ratio for sure.
Hey, let me take a couple of other questions. Todd in Texas, RSI 14. Yeah, that's the default. Wells Wilder tested a lot of different time frames. If you think about it, that's just shy of 3 trading weeks. There are 5 trading days in an average week. Steve in California, trade till May and go away. Well, that gets you leaning in perhaps one direction, but 2020 has not been a quote normal year in any stretch of the imagination. And that indicator works some years and some years it doesn't. We have to trade the market we have. And like we talked about, unless and until the market breaks down to lower lows, uh, we're in good shape.
All right. Let's see. We also want to compare the Qs to the equal weighted Qs. So this is the NASDAQ 100 market cap weighted is the QQQs, and then the equal weighted is the QQQE. And to make Mark not mad at me, I'm going to make it yellow.
Lee, I couldn't be mad at you, buddy.
Of course.
Gotta have some fun with it here and there.
All right. Hang on. Yeah, so the story here is, as you might suspect, the big companies in the NASDAQ 100 are fueling a lot of the rise. You can see, at least over the last 2 or 3 weeks, that has been the case. And then you can compare the Qs to the NASDAQ itself, and you'll see the same thing, I believe. So put up the NASDAQ composite. Yeah, it's not quite as stark, but it's certainly still outperforming both of those.
Mm-hmm.
But we all know what's, a lot of those big cap stocks have been pushing this, but the breadth is still not all that bad. Let's take a look at the breadth in the market on the NASDAQ, for instance. So we can take a look at the NASDAQ 100 advanced to decline line. There's no divergence there. Yes, it is underperforming. I mean, it's outperforming the equal weighted, but even within it, you've got pretty good breadth. Now let's take a look at the Nasdaq Composite breadth.
And that's about 3,300 stocks. Is that right?
Yeah. So you can see this is a little different, although I mean just over the last day or two, but still generally it's going in the right direction. You wouldn't call that a glaring divergence at all. And then let's take a look, as long as we're doing breadth, let's take a look at the S&P breadth.
Mm,
Eh, it's not quite as robust as some of the other ones
yeah.
because we're a little bit higher than we were back here, but so you could say that it's not quite as robust as the Nasdaq and especially the QQQ type stocks,
hmm
although it's not glaringly bad.
One other thing to take a look at in perhaps the breadth regime is, first of all, let's look at XLF, the financial index, and that's the financials in the S&P 500. And those are starting to at least come back to life a little bit. But
Hmm.
then let's compare that to, I think it's KBE, which is the regional bank index, mainly community and smaller regional banks.
That's KR right here.
KRE, okay,
Yeah. So you want to compare KRE to
XLF.
yeah.
I think we'll see that it has underperformed for quite some time, but now maybe like the Russell to the S&P 500, playing a little catch up.
Yeah. So
Mm-hmm.
yeah, you can see for the last couple of weeks it's gotten a little bit better. Now, and we can take a look at the money center banks too, can do the same thing. That's KBE. Again, has been showing some outperformance. What is really outperforming though had been insurance, but there's different types of insurance. As I said this morning, Merrill Lynch, your old firm,
Mm-hmm.
Mark, upgraded a lot of the major life insurers today. So take a look of those. It's not moving it too much though. I would have thought you'd get a little bit better chart there, but not really. This is
Yeah.
kind of range bound actually. Hmm. Let's just, as long as we're talking about sectors, let's just see what is moving today. So we got the airlines. Talk about the market looking forward.
Well, that's looking a long way forward. I live less than a mile from SeaTac Airport, and we're not right under the flight line, but we're off to the side. It is stunning how few flights there are.
Yeah.
I flew a lot for business, going to the different offices throughout the region. And typically, when you board an aircraft and you pull away from the terminal, you're between number 5 and 10. Some guys as many as number 12 or 15 for takeoff. Today, not a problem. We might see 10 takeoffs an hour. I use an app called Plane Finder that tracks airline actually and general aviation traffic. And there have been times in the last few weeks where I look throughout the entire state of Washington, picture that on a map, and look for departures that have left SeaTac Airport. And there are sometimes when it's zero in the entire state of Washington, headed north to Alaska, headed east, headed south. It's not at all uncommon to only see 3 or 4. So if the market's looking forward with the airlines, it's certainly a forward-looking indicator.
That's for sure. What else is moving? Gold we talked about. Copper miners, we saw copper. It's kind of the same thing. Uh,
UFO, look at that one.
yeah, well, that's doing well.
Space.
That's the space. Yeah, let's take a look at that one.
You might remember this one. Do you remember the ticker symbol BEAR, BEAR?
No, what was it?
Jack Nicklaus Golf, when it went public years ago. He was known as the Golden Bear, but
Yeah.
that takes some courage to put the ticker symbol BEAR on your stock. But
Just
UFO,
see what's in here. We'd have to go to schwab.com to get there. But yeah, I mean that.
I'll look that up for you.
Yeah. Let's see what else is moving today. We talked about the silver miners. Let's look at the gaming stocks. We've been looking at those, continuing their breakout that we pointed out. Many traders would say the next stop is probably the 200-day moving average up there, but acting well. They're going to open Harrah's, I believe, on the 4th. There's some open already on the strip. Probably caused the trading volume to go down, though. They're saying that people have been trading as opposed to betting on sports or Las
check
Vegas.
out DKNG, DraftKings on that one.
Yeah, I know that's been going nuts. What is this? I forget.
DKNG.
That's right. Yeah,
Client actually introduced me to that one.
Yeah, it's been going nuts.
So here are the top 10 holdings. And by the way, this is certainly anything we talk about, but in this one in particular, not any kind of a recommendation. If you're thinking of buying something on its 1, 2, 3, 4, 5th day up, not a good idea. So here are the top holdings in the UFO. Space is the 6th SPCE. Garmin, okay, I wouldn't have thought that as part of a space, but GPS, I guess. Yeah. Trimble. Orbicom, a company I've never even heard of, is the top holding at 7.4%. Maxar Technologies, another one I haven't heard of, 7%. Dish Network, 7%. Trimble and Garmin, 7 and 5.5 respectively. Space at 5.25. 3 must be foreign companies. And then Global Star at 5%.
Interesting. We got some more questions. Hindenburg or Titanic syndrome flashing? No, and they won't either. You've got to be near the 52-week high for those even to come into play. So we're too far off the 52-week high for those. Breast thrust, we could take a look. We haven't had one. Haven't had one, a clear one since 2018. We did have a couple of volume thrusts earlier in this rally. We can take a look at that. We'll take a look on the New York Stock Exchange. So we did have these, which was positive. We started getting series of them after the bottoms, which kind of confirmed it. On the NASDAQ, we really haven't had one though. In order to flash on this, you've got to have 9-to-1 up volume versus down volume.
And that's on the NDX or the composite?
That's on the composite.
Yeah, that would be pretty tough to do.
Yeah, it would be tough to do. All right.
So we've got about 4 or 5 minutes left. Do you think we have some time to work in some gaps there?
Yeah, let's do, you wanted to point this out. So let's go to the screener, right? You walk me through what you want to see, and I'll do it for you.
Okay.
Get the screener up here.
So we could use one of our predefined gap up, stay up. About 4 above that one. 3 down from the top of that. There you go. So when you have a company that gaps higher, and actually let's look at the criteria on this before we dive in. Companies can gap 2 different ways, either higher or lower. So just show the selected only. Okay. So what we're looking for here is last trade greater than the open. And is that greater than a dollar value?
It always does this. You want, you want the,
Last trade greater than open,
right,
and
so
then the gap,
this is a gap up, stay up, so,
right. Mhm.
and then
So
gap
what
is
we would
greater
call a
than,
gap and go. And actually, one of the things I prefer on that one is um, the percent gap. You've got a stock like Amazon that's trading, the next one down.
what, percent gap?
Yeah, percent gap. It's a different indicator. Sorry about that. You'd have to go to show all again. We may run out of time, but anyway, you take a stock like Apple trading at 300. I could care less if it gaps 50 cents.
Yeah, well,
It's got to be
that's-
something significant.
yeah,
So-
hang on, let me get the Street Smart Edge back up, that crap, croaked it there.
Okay, well, maybe we won't do this one today, but while you're bringing that up, I'll at least talk about the concept.
Yep.
So you can have companies that gap higher or gap lower. Then once they gap, they can do two things in each circumstance. They can gap and go higher or gap and trap lower. So a gap up and go typically can be a bullish indication, particularly if it's breaking out of a trading range. But it can also be somewhat of the gap and trap where it gaps higher and then fails. That can also be a very bearish indicator, particularly if that last gap is what we would call an exhaustion gap at the end of a fairly straight up move. So when something gaps lower and then goes higher, that can be a bullish indicator, particularly if happens at the end of a selling climax, because that can be an exhaustion gap on the downside. Or if something that gaps down and goes lower, that could be a bearish sign, particularly if we're breaking out breaking down from a trading range. So sorry we didn't get to go into much greater depth on this. We're almost out of time. When we come back in a couple of weeks, Lee, let's spend a little bit of time on gaps.
Yeah, what we'll do is we'll have some pre-built ones on there, and we'll have so we'll talk about a few of them. So that's good. Speaking about out of time, we are out of time, and I'm up next, so I got to prepare for that. So thank you so much, Mark, for joining me as usual on Mondays.
Always a
And,
pleasure.
Yep, I'll be back with directional movement indicators, so stay tuned.